Real Estate Investment Truth in Lending Act. Get ready because it's time to raise the stakes with real estate. The Truth in Lending Act provides rules and regulations to lenders, rules and regulations which are important for us to understand because they help us to understand how the information will be presented for financing options. That being useful because that will help us to be making comparisons between different financing options. Note, the Truth in Lending Act is going to be geared towards creditors in general. We here, of course, are trying to apply that more specifically to lending in a real estate type of situation. So we're referencing Investopedia. Investopedia, a place you can go to look at terms and definitions that are investment related, furthering your research there. The Truth in Lending Act, a federal law enacted in 1968 to help protect consumers in their dealing with lenders and creditors. So obviously it's a law aimed at protecting the consumers, dealing with the lenders and creditors. We here looking at in the context of the home purchase and financing of say, real estate. So it was implemented by the Federal Reserve Board through a series of regulations. Some of the most important components of the act concerned the information that must be disclosed to a borrower before extending credit, like the annual percentage rate or APR, the term of the loan, and the total costs to the borrower. So when we're thinking about our comparisons, there's no one number when we're trying to shop around, trying to compare, say, apples to apples, same thing to the same thing, when we have different financing options. But the more standardized the process is, the more standardized the loans are, the easier it is for us to be comparing one thing to the other thing. In other words, if the loans were structured completely differently, then it can be a little bit difficult for us, of course, to make the comparisons and see which option is going to be best given all the differences that are taking place. Now, note that this law goes to all creditors. So if you're talking about other kind of loans, like a credit card loan or something like that, they might do different things, right? You might do things like if a credit card company or if a lender wanted to deceive someone, what might they do? They might basically have fees versus having the interest rate, right? Kind of have a change about, are we calling it fees or are we calling it the interest rate that you're going to charge? They might compound differently. They might have the interest rate on a basis other than a yearly basis, meaning normally when we hear about an interest rate, we think about a yearly rate. They might put the interest rate on a monthly rate or a daily rate or show it in some other time frame, which is difficult to make comparisons about, and so on and so forth. Now, when we think about the home loans, then usually we don't have some of those kind of problems, meaning the interest rate is usually presented kind of at a yearly type of rate, and those things are going to be somewhat more standardized, and we'll also usually have kind of a standard setup of the loan process, which is like a 30-year fixed standard rate, and then we'll have deviations from kind of that 30-year that we'll take a look at in comparisons, which of course can be more confusing because they're not what we're used to in the norm, and they're not as prevalent. Therefore, doing comparisons of two different loan types, especially loan types that aren't as prevalent, can be a little bit more difficult. Now, one thing that could be useful is to try to use the APR, which is a way to give you one number that's trying to wrap into that one percentage rate, both basically in our terms, when we're looking at loans here, it could wrap in like the costs as well as the interest rate, meaning if they break out or try to represent the cost of the loan in terms of interest and other costs that are not included in the interest, and you're trying to compare two different loans, how could you get one number that kind of wraps those in? Usually we need some kind of percent to do that, and the APR could be useful. It's not going to be it's not just having the APR is not going to solve our problem, having one number to tell us which is the best way to go, but it's useful to be able to understand what it is for our comparison process. So they got to know what the term of the loan are and the total costs to the borrower. So we have to know upfront what the costs are going to be. So this information must be conspicuous on documents presented to the borrower before signing, and in some cases on the borrower's periodic billing statement. So we'll take a look at some of these kind of comparison processes. This really pans out when we look at practice problems and we're comparing standard, loans to less standard loans, and the APR and the interest rate and how the costs will pan out in there. So we'll work practice problems on that. So, how the Truth in Lending Act works: the provisions of the Act apply to most types of consumer credit, including closed end credit like car loans and home mortgages, and open end credit like credit card, home equity line of credit. So, when you're looking at this act, it's going to be broadly applicable. And so, you'll typically hear people talking about it if you're looking at it and doing more research with regards to how it impacts, say, credit card type, which we're going to call open-ended type of credit, like a line of credit kind of situation, and close-end, which is where we're at here, applying it to, which will be, in our case, the home loan or real estate type of financing. The rules are crafted to make it easier for consumers to comparison shop when they want to borrow money or take out a credit card, and protect them from misleading or unfair practices of lenders. So that's going to be the idea. Obviously, the lender themselves have an interest in making things transparent. So even if there wasn't a regulation like this, you would think that there would be a gravitation towards an industry standard. And I think that will typically be the case. And that's going to be kind of your safer zone to be kind of in the industry standard, because there's usually a reason why it's the industry standard, right? And then when you deviate from the industry standard, then that's when you're taking on generally more risk in general. And it's going to be a little bit more confusing to weigh the pros and cons as you deviate away from that. We'll look at kind of examples to see these comparisons. So some states have their own variations of the Truth in Lending Act, but the primary features remains the proper disclosure of key information to protect consumers as well as lender and credit transaction. Truth in Lending Act example: it mandates the kind of information lenders must disclose regarding their loans or other services. For instance, when would-be borrowers request an application for an adjustable rate mortgage, an ARM. So notice, an adjustable rate mortgage is something that deviates from the standard kind of 30-year fixed mortgage. And just through that deviation, when you have all these, like when we went through a period of time when these things were called new innovative things, right? And they were being more and more popular type of loan options. The fact that it is a deviation, again, would make you think, well, there's a reason, kind of, there's a standard, is there could be a place for them. Not saying you wouldn't want them at a certain point, but you're going to have a more specialized need. You got to be more careful and know exactly what you're doing with those types of loans. So they need to be provided with the information on how their loan payments could rise in the future under different interest rate scenarios. And when some of these different kind of loan options became more prevalent, when they first became more prevalent and were kind of pushed as something new and innovative, like a new idea has been created, then people may not be as aware, right? And then as time that they're different, they take on different types of risks. It's hard to compare to the standard. And as time passes, then people become more aware of these different changes and when they might be useful or not be useful. So it also restricts numerous practices. So for instance, loan officers and mortgage brokers are prohibited from steering consumers into loan that will mean more compensation for them unless the loan is in the consumer's best interest. So in other words, whenever you're dealing, with a loan agent or anyone that's involved in the real estate process who's going to be benefiting, getting some kind of commission, in other words, there's an agency problem. They're kind of acting as your agent, acting in your best interest, but obviously they have their own interest involved as well. And so it's just human nature that there's going to be incentives for them to possibly steer in, kind of a bait and switch type of classical bait and switch thing where they're going to put you into a loan where they're going to get a higher commission or something like that. Now, obviously, you can put in a law and say, well, we restrict, we say you can't do that. We say you can't, try to steer people into a more beneficial option. But as we can't depend simply on the law, to do that, generally we got to do our shopping around, and because it would be hard to enforce that in a law, right? It's kind of a vague thing. You can't just, steer someone into this type of loan unless it's beneficial. Well, we don't really know. It's a complex situation to know whether it's beneficial. So you got to be aware and determine yourself whether it's going to be a beneficial type of situation to take on one loan or another loan. Also, of course, note that, again, this law can be a good thing for standardizing, but the industry itself most likely would be gravitating towards industry standards, and the industry standards are probably a standard for kind of a reason. So you'd want to be thinking, okay, am I deviating from the norm, from the industry standard? Why do I have a reason for deviating from that norm?